everyone, Jim and Chris back with another update. Happy New Year 2025.
We made it.
We made it, and we're excited for it. There's a lot of things that are coming down the pipe for the year ahead, but there's a couple of main things that we want to focus on today that I think are going to really have an effect on your investing strategy and your investing outcomes if you're really serious about our build to rent model. Chris, you've been working a lot for the last decade with more the institutional side of things, and you've been seeing a lot of interesting trendings in a good direction with that, even with our building operations. I'd love for you to share that because it really does affect the smaller investor, and we're going to talk about how it can actually help them too.
Sure, yeah. Well, we're starting to see the institutional guys jumping back in a big way. We've signed more contracts for fee build, so a portion of our business will build homes for other folks. So these institutions that buy a piece of land and they need 200 houses built, we'll go on a fee basis build those houses for them. And we're really seeing that side of the business pick up. So in 2022, the last half of 22, it died off. 23, it was almost non-existent. And then 24, we started seeing folks ramp back up from an institutional side. Saw a lot of institutional contracts come through in 24, and we have a bunch more that are scheduled to sign here in the first quarter of 25. Which tells me the institutions are seeing, what is coming. This is what we all look at. I think from our perspective, we look at it and say the pain is almost over. We're working our way through, and I say we, the industry as a whole, is working its way through the extra rental inventory that was on the market. Left over, kind of the hangover from COVID when nothing could get delivered, and then everything got delivered at once. And that's almost done. Our internal belief is that the last bits of those, that inventory is going to come online by February, March of 25, and we should see most of the excess inventory absorbed, by August, September of this year of 25. Yeah. So we're feeling good that we'll start seeing some, potentially moderate rent growth, or at the very least just faster lease ups by the end of 25, which ultimately, puts us into a good position for 26, both for, rent gains, but also for pricing. So, absolutely. I think, those of you that own houses right now, while you're probably all in a good equity position, if you bought a house from us anytime in the last 10 years, but I would say, I think I would still say hold if you're planning on selling. If you're at the end of your 7-year or 10-year hold, I'd give it another year. Let these interest rates come down a little bit. I think that's going to have a big effect on pricing. If you haven't bought anything yet, probably now is the time, because as these rates go down, we're going to start to see housing prices go back up. So that's what I'm seeing for, really that's more 26. Those are more 26 predictions. It's kind of still get through 25 here.
Yeah, but there is no inventory coming behind. That's something that I know we've done some videos on. Chris has been really monitoring that closely. We are way down on permits, and you can't, unlike a widget company, let's turn up the machine and produce more widgets. When you're building houses, you have to go through a very clear process. And when you stop, when you raise that red flag and things come to a halt, it takes a while to get it going again. We're talking 1.5 to 2 years. So for what we're seeing at the end of this year, by end of summer, if this inventory shortage occurs, which we don't see unless there's some miraculous way of houses are created that we've never seen before, then there is going to be an upward pressure in your favor. And that's why for so many of our counselors, myself on lots of podcasts that I'm on, if you're not looking to buy a property for another 3 years or so, that's fine. You're watching the videos just to get some education, stay in the know, that's great. But if you're looking to buy sometime over the next year, we're highly encouraging our clients to buy over the next 6 months. And that's not some sort of sales technique. It's because with these fundamental numbers, if the inventory levels go down to where they are and the growth in Florida, we're still hitting that 1,200 person a day, there's going to be a problem with that. But if you already own property, you're going to be able to have that wind at your back for both the value increase and the rental increase. What are you seeing, Chris? I know we talked about too. I want to get back to you were talked about interest rates, and I know that some of our institutional clients have been a little bit, let's say, angry at our small Main Street investors, and I want to talk about that. It's kind of a David versus Goliath, but David's winning right now.
Yeah.
You maybe want to explain what's happening with that.
Well, what Jim's alluding to is, we have these incentive programs where, we're able to buy the rates down to 3.75% for our clients, which is just, unheard of. The institutional guys aren't getting rates that low at this particular moment in time. So, how they're resolving that issue is they're having to put in more cash. So to get the debt coverage ratios to work, they're coming with 50% cash and 50% debt. Whereas our clients are able to get the 3.75% interest rate and still just put down 25% cash.
Big difference.
And get 75% debt. So, it really makes it appealing to buy in this environment where everybody else is paying 7%, but it also gives a bit of a competitive advantage because you got more buying power. If you got 75% debt versus 50% debt, and you're trying to deploy as much cash as possible, you're using the bank's money. So you're using that much more of the bank's money, which when prices go up, you're getting all the uptick. The bank isn't. So so it's really right now this kind of odd dynamic that I've never seen before, where the smaller investors actually have a competitive advantage from a financing perspective from the institutional guys.
Yeah, and not only the financing being such long term, and we're talking a lot of the times almost 3% lower, not to mention the down payment, but also insurance. As an individual investor, big institutions, they're seen as more of a risk because they own so much. So the insurance rates that our clients are getting, our direct investors are getting, are substantially lower, which again helps the cash flow. So we're loving to see, again, we work with all of our clients who like both, but it's great to see the Main Street investor having this cutting edge advantage right now. And that's not going to last. That's one thing I'll say. Again, we're going to be really honest this year with our updates. We're expecting another 4 to 6.
Are we not honest every year?
Well, we're going to be brutally honest. Don't wait. Don't wait, because there's going to be another 4 to 6 rate cuts. And when those rate cuts begin to happen, like we talked about, there's about $900 billion sitting on the sideline from the institutions. And once that gets in, they don't have a lot of emotion. They don't have a lot of hesitancy. Those rates drop. You are going to be going up against the bigger guys. Right now, you have the jump on them.
Yeah.
And so again, we're encouraging our people, if you're really serious this year about building your portfolio, as Chris said, I would hold and I would also add. And that's what we're seeing not only for ourselves, but some of our top clients. I do want to switch to one last subject, and that's Florida. There is a lot of confusing information going out there about Florida that just doesn't make sense to Chris and I from the statistics we see, or actually, the real numbers we're seeing with thousands of properties. What's going on with Florida, Chris? I know, what is the one factor we're looking for the markets we're building in for our investment properties?
Well, everything for us comes down to affordability and population growth. Mm-hmm. And, we pretty much everywhere in Florida, with the exception of, Miami and even some parts of Tampa that are not affordable anymore. But everywhere that we are, Jacksonville, Palm Coast, Ocala, Southwest Florida, these are all very affordable markets. And really, you want affordability, but you also need people coming to fill them up. And right now, I think I just saw Florida is still the second fastest growing state in the nation. So, we got plenty of people coming to fill up the houses. So it's just a matter of time.
Yep. Yeah. And so affordability is where we're going to stay. Again, a lot of we didn't invest in Miami. We didn't invest in Orlando. We weren't in Maine, Tampa. It just didn't make sense with the median prices being more than double our other areas and the average family income only being a few percent higher in a lot of states. So what we look for is, again, that affordability. That's where we're going to continue to build. That's what we're going to continue to look at, because that's where we feel is going to be the best baseline, not only to hold value, but as this inventory shortage really kicks in, these are going to be the properties in highest demand, because a lot of the other builders will not build this workforce housing that we focus on. So exciting year. Again, we're seeing the institutions come off. We're still able to get our incredible loan incentives, which are getting our Main Street investors like you off the bench with incredible rates, long-term, free property management. Again, talk to your property counselor like that. And I would encourage you with really dive through any of the information or headlines that come out for real estate or Florida. Who's telling it to you? And what merit does it have? Because again, I saw some very funny things over the last week or two about Florida that just didn't add up when I actually looked at the statistics. Like for example, right now, inventory levels in the markets that we build in, most of the main markets that we build in, are about the level of 2019. That was a very normal market before COVID, before all the craziness. So we're excited for that. Chris and I like to work in normal markets. It honestly wasn't very fun working in a market where, there was, not even 2 weeks of inventory on the market. It felt good for a little while, but not after that. So a normal market is a good thing. That's where we're seeing. We've got a lot of wind at our back, and we're super excited for this year. So anything to add to finish out?
No, I think you should just touch on the ITR.
Oh yeah,
side.
so ITR right now, as you guys know, if you've been watching our videos for a year, ITR Economics, I've been in their community for a number of years, a client of theirs. They have been predicting everything within a 94% accuracy since the early 80s. And I read a book when Chris and I first started teaming up many years ago, before new construction. This was the old foreclosure days. I read a book that they wrote called the Prosperity in the Age of Decline. And it talked about our exact type of markets and our exact type of housing and how that was going to really have a major effect on the U.S. housing market and a profitability over the next 25 years. And that stuck with me. And then all of a sudden we went from the old houses to the new construction, which has been such a blessing. And I still follow them on a monthly basis. Right now, and you can look at this chart that's coming up right in front of you, you can see where the housing market is called by RTR Economics. We are just coming out of a bottoming out and recovery. And we feel really lucky about that because it really wasn't that bad. I mean, I went through 08, totally different situation, totally different fundamentals. But what we just went through with this last recessionary period, the COVID after effect, the interest rate jumps, we're now going into an upward swing that they're predicting for the next 2 to 3 years. And you can see you always want to get in at the bottom of the curve. So we're really excited about this. And again, these guys are not clickbait guys and are very straightforward in the reason why they get this. And again, they are one of the biggest proponents of saying we have an inventory shortage still. We have not supplied enough housing in the affordable range since 2008. And that's why Chris and I are going to keep just plugging away with the team on this workforce housing. Big houses are great, but we know our niche. We know where we can make our clients the most money, and we're looking forward to staying in it. So I'm grateful. But check out ITR. I highly recommend them. They have been a real guidepost for our model.
Thanks, everybody.
Talk to you guys next year.
Talk to you soon.
Next month. Take care.